Good morning and welcome to the Killik podcast for Friday the 6th of May. So year to date we've had a very different market to what we had in 2015. That was a momentum-led market. Now we've got a value market. So industrials, energy, commodities have all performed very well. That has been driven by better numbers from China and a weak dollar. So that outperformance has stalled slightly because we saw a poor number from China at the start of the week. Relatively, it wasn't particularly bad, but we've reset the bar higher for China. We've also seen a sort of stabling out of the dollar rate. So the next move for that momentum value story is probably going to be where the dollar goes from here. So we're looking at the macro data to get a sense of that. And today we've got a very important piece of data, which is non-farm payroll data. And we think it's particularly important at the moment because you've got this disconnect between very low expectations of interest rates going up, but you've got the unemployment rate below the level at which you start to see inflation in wages, and therefore interest rates needing to go up to counteract that. So here is the unemployment rate below that rate that the OECD specifies as the rate where you see inflation coming through. This is the expectations for a rate rise in June. So that's been beaten out of the market, and the same sort of thing has happened to rates going up later in the year. So a big number today, you'd see a big sort of rise in yields, which have a big impact on sectors in the market. A poor number, and you'll go back to recessionary fear and worries about the efficacy of central banks. Next week, we've got SolarCity reporting on Monday, so I think it's a good time to just revisit our positive view on US solar, which is not really consensus at the moment. It's derived from two pieces of legislation. The first one is the Renewable Portfolio Standards legislation, which requires a percentage of all energy sold to be renewable energy. That is increasing from around 30% to 50% by 2015. The second is the investment tax credit, which was extended in December. So this tax credit means that 30% of the investment cost can be recouped over a 10-year period. That was previously reassessed on an annual basis, and that's now been extended until 2019, and then a 3-year phase out. So the industry now has 5 years of visibility on which to build their businesses, and that's important because over the next 5 years, the cost of producing solar will fall around 25%. At that point, you'll be in a position where you can produce solar at parity to fossil fuels without any subsidies. So that is a bridge to that parity world. Now, with a strong domestic market, because of the legislation, these businesses can now become global businesses, and they can go into areas of the world where the climate is more conducive to solar power and the fuel costs are higher, so the economics are that much better. Now, in the market, there's a lot of sort of uncertainty around the solar stocks, particularly SolarCity, and that's because of a number of reasons. Firstly, we have uncertainty in distributed solar about what the costs of accessing networks are for the solar companies, and secondly, what price can you get any power that you don't use that you've generated from solar, what price can you sell it back to the utilities? We've also had the SunEdison bankruptcy, we've had oil price weakness, we've had pressure in high-yield funding markets, and they are needing to access these funding markets. And thirdly, lastly, you've had companies paring back their growth targets because of these uncertainties. So we'll go into the SolarCity numbers looking for a little bit more evidence that this company is addressing those uncertainties. So we'll get details on the asset monetization deal they did this week, which is the first of its kind for SolarCity. We'll get more details on the state-level regulatory developments. We'll get more details on their attempt to become a vertically integrated solar company, which takes them away from the distributor model issues that I was talking about previously. We'll get further surety on the 2016 guidance. There's doubts in the market about them making their previous guidance, so that'll be keenly anticipated. And finally, there'll be more evidence on a changing tact in terms of partnering with utilities, which we think is important to access that more stable generation market. So apart from Solar City on Monday, we've got Walt Disney on Tuesday, we've got Compass Group on Wednesday, and that's it from the Killik & Co stocks. That's it from me. Thanks for listening. Have a good weekend.